Thank you all for joining us today. As you heard, my name is Dave Goodsell. I'm Executive Director for the Center for Investor Insight. I'm also a member of the AMC's Research Committee, and the Active Managers Council is an organization formed by the Investment Advisors Association to support education and research on the value of active management. Since 2017, AMC has produced a number of white papers, underwritten academic research, and curated educational content on active management, which everyone can find at activemanagers.com. And that's where you can find our recent report on ESG, which is called Sustainable Investing is an Active Process. And today, we're going to tap into that research and the experience of our panel to explore three important topics for financial advisors. We're first going to look at why more and more advisors are focused on ESG in their practice. We're going to talk about how it can be integrated across your practice. And then we're going to demonstrate why active management is better suited to ESG. Today's panelists have unique perspectives and approaches to ESG, but they have one thing in common. Each of them sees ESG as truly the domain of active managers. And I'd like to start by asking each of you to introduce yourselves with your role in your organization. Maria, let's start with you.
Absolutely. Thank you very much, Dave. I'm the ESG analyst at Loevner. We're a public equities manager investing globally, focused on international and emerging markets. We have been investing in high quality, long duration growth companies for over 30 years. And we see ESG as material, and we systematically incorporate ESG considerations across our strategies and also work with clients with additional needs.
Mason, how about you?
Hi, thanks, David. I'm Mason Gregory within MFS Investment Management, and I am a part of our investment solutions group. And I'm an ESG analyst focused on working with our investors and our clients to describe our approach to ESG and sustainable investing and educate both our clients and other external parties on what our approach is and our philosophies and beliefs.
That's great. And Jennifer, how about you?
My name is Jennifer Wu. I'm the global head of sustainable investing for JP Morgan Asset Management. So over here, the work that I do is effectively build ESG expertise across all of our investment desks, and then really help our clients to achieve whatever goals that they have in mind, be it financial return using ESG, or achieving a sustainable outcomes that they may desire.
Well, thank you all and welcome. So glad to have you here with us today. Let's just kind of set the table here, a little background. Where are we at with ESG? Right? The industry is clearly focused on it, but there's so many different strategies. There's so many different applications. It's hard to know which approach works for which clients and which needs. And one of the things we see in our research at Natixis is that there's a big disconnect between clients and advisors when it comes down to ESG. For example, when we ask platform managers in the US, the number one reason that they're putting ESG on platforms that advisors choose from is client demand. That's 7 in 10 are telling us that. 8 in 10 investors tell us they want their assets to align with their personal values, yet only 9% of the advisors we spoke with in the US this year said their clients are invested in ESG. But what's interesting to me is that individuals kind of recognize the core thing about ESG is that almost half say they want to make that values alignment that's important to them, but they're not willing to do it at the cost of returns. So from our view, it's a good thing that it's not an either or choice, but it does mean some extra consideration when you're selecting a strategy. So I want to start with the background from our panelists. If each of you can offer how your firm looks at ESG, and more importantly, how are you implementing it in your strategies? Mason, let's start with you.
Okay. MFS is a long-only equities and fixed income manager. And we have a very focused investment process that has been pretty consistent since our founding almost 100 years ago. We're focused on identifying sustainably managed companies that we can buy and hold over the long term to add long-term value for our clients. So ESG fits very naturally with that because as fundamental bottom-up managers, we're looking closely at companies trying to identify, those well-managed companies that are positioned to outperform over the long term. And so we have to understand all the various risks and opportunities that those companies may face over our holding period. And ESG is a huge part of that. They're extra financial externalities. However, they often impact the balance sheet over the course of an investment period. So we don't manage to non-financial outcomes. We don't offer values aligned products, but we are focused on aligning and allocating capital to well-managed companies that are creating value for shareholders and stakeholders as opposed to extracting it.
Mason, thank you. That's a great overview of things. And excuse me, Jennifer, can I ask you next? How do you see it at your firm? I know you oversee all of ESG. How do you guys look at it there?
Yeah, so we are a U.S. asset manager that invests globally. We have coverage across all of the big markets around the world. We invest in equity, fixed income, alternatives, and we also, majority of our assets are actively managed. So for us, I think when it comes to ESG, we use it in two distinct ways. Because at the end of the day, the way we interpret ESG is that it's not just the one thing, right? It's a collection of what we call information, data, and issues that are not traditional, non-traditional financial metrics. So the first way that we use ESG for is to really use ESG in such a way that helps us to identify risks as well as investment opportunities that we were not able to identify before without these pieces of information, right? So the single objective in that case is to use ESG to enhance our risk-adjusted return. So this is about integrating ESG data into our traditional investment process, just like how we currently and have always been doing things like integrating inflation risks or sales forecasts. So we very much focused on the ESG data or factors that are what we call financially material and integrated into the process to generate better return. The other way we use ESG is realizing how there are, more clients who are interested in, aligning their values to how they invest. So in this instance, beyond what we just, what I just said about how we use ESG to generate better return, we also use ESG as a criteria to exclude companies or tilt portfolio in such a way that the strategy actually is able to generate a social or environmental outcome, specifically aligned to what the client is looking for. So that's how we use ESG. So across the board, we've gone through a multi-year process to ensure that financially material ESG factors are incorporated into all of our actively managed strategies. And so currently we've got about 2.1 trillion on assets under management as ESG integrated. And then beyond that, we also have a dedicated suite of products that are more values aligned, and it's about 4 billion of assets under management.
That's great. Thank you, Jennifer. And Maria, tell us a little bit how you look at it at your firm.
Sure. So we've been thinking about ESG for a long time because as we care about the sustainability of long-term earnings and we care about good corporate governance. We don't consider ESG issues for the sake of considering them. We do so because we believe that it allows us to arrive at better conclusions and at better risk-adjusted returns for our clients, and just works well with our long-term focus. ESG is fully integrated into our investment process. So the analysts remain in charge of ESG assessment for our companies, and they're also responsible for rating all of the companies that we follow, using our proprietary ESG scorecard that we've had in place for almost 5 years. So this allows us to ensure that systematically we're capturing the impact of ESG on looking at financially material issues, and also makes the process transparent, allows for debate, which we value, allows for better decision making. Also, as part of the debate and discussion, it also allows you to unearth opportunities, not just risk to the companies. And then engagement, likewise, is also done by the analyst, and so allows us to leverage the relationship that we already have with the companies. Now, in addition to that, so we do this for across our strategies, we consider ESG from the financial risk materiality perspective. So in addition to that, we offer tailored solutions for clients, for separate account clients who want to align their portfolio in a specific way. And so we've done exclusionary for a long time. We can tilt portfolios using third-party scores. We can also work with clients that have other objectives, such as the carbon emission reduction that they'd like to achieve for their portfolio.
Thanks, Maria. So what's important here is the reason I ask how you each view it and approach it is, I'm going to go to the next question, which is much more directed at financial advisors. I hear about risk-adjusted returns. I hear about customer experience and customization. So why should advisors be thinking about ESG more and more in terms of how they manage their practice? And Jennifer, I'd like to start with you on this.
I think if the intention is to generate better financial return, and if you're financial advisors and you're looking at different product providers, different asset managers, and try to figure out who actually has a product that can help your clients to achieve better financial return, you have to think about ESG, because we live in a world whereby there is just a lot of new data that's out there available that allows us to do a better job in assessing what actually is going to be the cash flow of the company in the next 2-3 years, because of this particular issues around how well they're managing their natural resources or human capital, which could impact cash flow, productivity, so on and so forth. So I think, thinking about that in the context of whether your manager is doing a good job in doing as much as they can, gathering any information that's financially material. And I think it's really in line with our fiduciary duty to do everything we can to actually enhance that return. I think it's really quite critical and important. And I think the other thing that we need to recognize is that there are new phenomenons, right? ESG is data information phenomenons. There are things that we didn't have to think about in the past. For example, we never had to think about cybersecurity risk, but we have to think about that now. So you could call it, well, maybe this is not ESG, but the way we think about it, if you think about one of the G component is risk management, right? So cybersecurity risk is now a very important component of the G. The other area, which is related to the S, that's concerning cybersecurity, is product safety and customer data. So in a way, I think ESG is a collection of different things. And it's easier for us to use that as a collective term to talk about some of those new insights that we're incorporating into the investment process. So I think even purely for the purpose of generating better risk-adjusted return, you want to make sure that the managers that you pick are actually using these data to deliver better results.
Oh, thank you so much. I mean, that is a really important point of it. I think sometimes people forget the performance contribution that can be made through this, the way it affects decisions in the portfolio. Mason, can you talk a little bit about how advisors should be thinking about that in terms of their own practice and how they approach things?
Sure. Yeah, they certainly need, I totally agree with Jennifer, they need to be aware that ESG has a real performance impact. And it's a challenging discussion to have because in terms of ESG integration, it's really difficult to measure what that is. But there are certainly ways that you can see its effect, situationally. If you have, a great example to use cybersecurity, as Jennifer mentioned, it was Equifax. That was a material impact to that company based on a growing risk that a lot of companies are facing. So that's the kind of issue that investors need to be thinking about, and analysts needs to be looking closely at to make sure that they're engaging with these companies to talk about how they're addressing these risks, how they're managing these risks, how they're viewing these risks. And a lot of it has to do with developing confidence with the management teams and understanding what their views are. Do they align with the investor views? And do we feel like they are well positioned and well equipped to mitigate, many of these risks and take advantage of the opportunities? Climate change is a great example of an area, that people tend to think of as a risk, and it is. There are a large number of risks that stem from climate change, but there are a lot of opportunities too. And the trend that a transition to a low carbon economy offers. We have, a great deal of industries that are transforming and new technologies that are coming online. And there's a tremendous amount of opportunity, and many companies are taking advantage of it.
So if I summarize some of what I've heard here too, is that, we may be hearing about it from clients in terms of value alignment, that they're making that request. The other side of this too is the value that you're creating for that client in the portfolio. It enhances what you can provide. Now, the other part of this, and Maria, I'm going to start with you on this question, is, there's a lot of different ways, right? We have best in class, negative screening, integration, thematic. There's so many different ways of implementing ESG. what do advisors need to know? And I guess maybe what do these strategies do and what can't they do? What's the important stuff to recognize here?
Sure. So there's many different approaches to it. So there is integration that we've all spoken about, where ESG risks and opportunities are integrated into a process. And that's the approach that we use that makes most sense to us. But there's also the exclusionary approach that allows clients to exclude certain areas, which as I mentioned, we also do and have done for a long time. We don't do thematic because we believe that diversified global portfolio is really the best way of approaching investing. We don't have thematic products, not only ESG related, but thematic products related to sector funds, for example. I think one approach that is interesting and that we have discussions and debates about internally is the best in class approach, where some of the investors are looking to tilt the portfolio towards the companies that are rated best, for example, by external providers. And so I think the argument there is that maybe, as with the quality premium, the value these companies bring is not fully recognized. And so these companies can continue outperforming over the long term. Conversely, if you see crowding and if you see investors pursuing particular companies, particularly based on sentiment, and particularly around issues that are not necessarily financially material, you can actually have diminished opportunities going forward in these sets of companies. And I think that's why active management is so well positioned, because investors that look at ESG separately, investors that incorporate ESG risks and opportunities among other risks and opportunities, can identify companies where maybe the risks is overly discounted and the companies where the sentiment is overly optimistic and take advantage of that.
Sure, thank you. I'm going to move to Jennifer next on this. And there's an interesting question, I think, that comes out with so many different ways of applying this idea of ESG, so many ways of implementing. What's the way to think about it in terms of approaching a client? Which type of thing can help with which type of client need?
Yeah, so I think that's a really important question, David. The starting point should be trying to figure out what's the intent, right? So if the intention of the client is solely focusing on financial return, I think the best approach is ESG integrated, right? Because ESG is used in such a way to generate better return for no other reason. If there is an ESG factor that's just a nice to have, doesn't impact valuation, doesn't impact cash flow, in our process, we wouldn't use it. So I think it's very important. And if a client's intention is to do above and beyond financial return, right? They also want to pursue some social outcome. That's really where we get into the few approaches that David and Maria you just mentioned, like best in class and all of those. So I think the way we think about it is that if the intention is to avoid investment in certain companies or sectors that just don't align with your personal values, negative screening is a really good approach to do that. Recognizing, however, though, the more you shrink your investable universe, the higher the volatility is, there could be a return trade-off. I think this is investment 101. We all know that, right? It doesn't matter what you exclude, there is that risk. And if the intention is to promote companies that do a really good job in managing human capital or have very good governance, you could potentially do a best in class, which is you zoom in into companies that are, to Maria's point, highly rated from an ESG standpoint. So you don't basically try to strike a good balance between risk and return across the entire portfolio, but you're very concentrated on the top performers. And when it comes to thematic, I think it's usually mainly related to specific outcome that you're looking for. So for example, like gender equality. For instance, one of the strategies that we offer is for clients who want to align their portfolio to something that promotes gender equality. We could do that by offering them in investing in female enterprises, right? So in our private equity portfolio. And then finally, when it comes to impact, this is really about promoting social change, in my view. So we see a lot of those impact-related products are actually in the private equity market, because that's where you can draw like a more direct link into as to like why, by way of investing this, you actually were able to say improve public health. So, for instance, in our municipal bond offerings. We do something around, focusing on healthcare, and also education, etc. So that's how you would you can think about in terms of what should be the right types of strategies and approaches that you offer to your clients. You start with the intent, and then figure out what's the right approach to suggest.
Thank you, Jennifer. The great points across all of those. Mason, before we move on to the next question, integration. Is there a way that advisors can be thinking about integration and what it provides? What does it do extra for them in what they're selecting for their clients?
Sure. One of the important things to remember is that, particularly with active management, evaluating companies from the bottom-up perspective and really getting to know them well is critical, because a lot of the marketplace is relying on a few independent ratings providers, and all of these organizations have their own bias, and it may not align with yours, and that has a lot to do with your investment time horizon and your particular values and what you're focused on in terms of particular ESG issues. So while it's critical for advisors to be aware of the different approaches to ESG investing, and particularly as it relates to ESG integration, how it can improve investment returns and risk management. But they also need to be aware that, particularly when they're looking at things like best-in-class portfolios, it's a good idea to sort of take those, if you're using third-party ratings providers, take their conclusions with a grain of salt, and do your due diligence, because there's a lot of reliance on them across the industry, and there's what we see in the marketplace is something of a growth bubble, because a lot of these companies, because there's such a bias against climate change and emissions, for example, tech has gotten an enormous boost. So you have to sort of be mindful of that and careful and thoughtful about it, and really communicate with your managers about how they're approaching ESG integration, and learn about their process, and talk about stewardship and how they're having conversations with companies, so that you can understand that they really understand on a very deep level what these companies are doing, what their perspectives are.
Oh, that's a great point on it, right? That added layer of being able to look into it. And I think, Maria, this gets to a point that you were bringing up earlier too, which is, it's about active management. So we're the Active Managers Council. We're here to talk about, this idea that, this is really an active part of decision-making within investment selection. So can you give me a sense of why active management is so important to this? How does it fit together for folks?
Absolutely. So I think it's interesting, even in identifying which issues are material or in how they measure them. If you look at the third-party rating agencies, there's a degree of judgment that they must make in arriving to this. But that's just the first step in the assessment, identifying what companies' potential exposures are. What you really need to do is then understand the company and understand the industry structure and the company's competitive position. So like I can give you an example. If you have two textile companies and both of them have to spend more on CapEx in order to comply with carbon emissions mandates from their clients. If you have one that's larger and more well-funded and that has strong pricing power with the client, they can pass that cost through, and the other one cannot. And so for one, that could be an opportunity to gain market share and to grow, and for another, it's an additional cost. And without understanding the industry structure and without understanding the company, you just don't know what that exposure means. And that's why I think it's very important. I also think that engagement, when it's when it's integrated into the investment process, like I said, we have analysts who are engaging with companies on all topics, including ESG. We think that can leverage the existing relationship that you have in place with the company, and that can be very important. So I think that that just inherently makes it such a better fit for active management.
Oh, that's a great way to look at it too. And Mason, I'm going to go to you next, because one of the things that's in the paper from Active Management Council talks about the fact that things can be assessed in short-term and long-term sense as an active manager. And you had some interesting things to say about being forward-looking Maybe you can fill us in a little bit on that view for you.
Yeah, it's a really important distinction that in a passive context, well, passive generally is backward looking, but particularly as it relates to ESG, because they're passive investors are sort of forced to rely on external ratings providers, and those ratings reflect past behavior. In fact, there's a lot of pressure on those ratings providers to reflect past behavior. And that doesn't, assuming an active manager isn't also using the ratings to make decisions in a large part of the investment process, and they're really evaluating those companies on an individual basis and forming their own conclusions. That's forward-looking, and we've seen a lot of examples. One of my favorites is Volkswagen, which is a company that's extremely well positioned in their industry right now, but they're still being penalized by Dieselgate, particularly by the ESG rating companies. So there's an opportunity there for active managers to take advantage of that disconnect. And that is very common across a number of different industries. So active managers aren't beholden to those ratings, and they can form their own conclusions. And that forward-looking aspect of an active approach can add a lot of value for investors.
Jennifer, how do you look at this? Because you have a number of ways of implementing, you have a number of different strategies. How do you look at the role of active management in ESG? Why is it so important?
I agree with a lot of what Mason and Maria had said. I think at the end of the day, if you think about it, there's a reason why we're all talking about ESG as if it's a new thing, because it is to a certain degree new thing. What that means is that whatever kind of ESG information you get from companies is not standardized, and not all companies provide these type of data. So, and that's really where I think active manager comes in, because no matter if you want to use ESG to generate better financial return or to drive a social outcome, it's actually really hard to do. So for example, we see how a lot of those large cap companies seem to have pretty good ESG ratings according to third-party data providers. A big part of it is because they disclose more data than anybody else. And also, companies don't have incentives to disclose something that could work against them at the end of the day, right? Since there is no mandatory requirements as to what you need to disclose, and also what that should look like. So the kind of work that we want to do as an active manager is to not only take what companies disclose at face value, which is what a lot of the rating agencies, because of the fact that they can only rely on reported data, as a result, they can only, their scoring is based on that. We look under the hood. So for example, to Mason's point, forward looking, right? We're in the business of forecasting in a way. We want to know who is going to be the winners in the future, not based on historical data. Controversies. So potentially whether a company is potentially violating an environmental regulation or doing something horrible when it comes to human rights issues. That kind of information you will not find in any company reported ESG data. So what do? We do a lot of engagement with companies, but also I think what's exciting about ESG research is that at the end of the day, we have more data than ever before. We also have better technology. So could we actually tap into some unstructured and alternative data sets that can tell us a bit more about controversies? So for example, one of the database that we're exploring is an aggregator of different NGO data. So, and the intention there is there something that we can find information about a potential violation that a company has committed? It's not being picked up by mainstream media yet. It's not being reported by anybody. And that could be a useful forward-looking signal that we can build into our valuation model. And then I think also it's very important for the context of how if you want to use these ESG information to drive what I call real world change. Because if you don't know what's actually happening, how could you expect to drive real change, right? So if your intention to use ESG is to drive a social outcome, you want to make sure that you're talking to companies about the right thing and that you're pushing them in the right direction. So one example would be, I think a lot of more and more companies are now being asked by their shareholders and investors about how they need to come up with a plan to reduce their carbon emission or carbon footprint. It's quite easy for any shareholders or external parties to just tell the companies, this is what you need to do. You have to come back with a plan. But it's incredibly difficult for any company to suddenly change their business mix from oil and gas to renewable like in one day. It takes multi-years, and then you need to think about all the different implications. And I think this is where active management can really bring values in, because we have, you know, investors who understand these companies very, very well. The kind of engagement that we do is very detailed, in the sense that we can set mini goals with the companies that are realistic and practical, and agree on the long-term plan and work with them on these things. So I think it's really, really important to be able to do engagement in such a way that you're able to provide very concrete plans and targets for companies that they could actually you know, achieve, and then also be partners with them such that you could help your clients at the end of the day to drive some real change in those company behaviors, etc.
Well, that's
Dave, if I could just double down on that, it is, you know, the data is a work in progress. You know, we sort of, I think, get the sense a lot of the time that it's sort of more mature than it really is. And there's a, you know, growing number of initiatives that seek to gather more data and encourage companies to disclose more and create frameworks and standards. But a lot of that, you know, remains in the future, which is why engagement is so critical to really get an understanding of you know, the thought process that's going on with these management teams. And an active approach to that is, you know, it's a completely different animal than the passive companies, because, you know, active managers have targeted exposure, they have targeted ownership, and they know the companies intimately, and they can talk to those companies over time and really observe behavior as well as encouraging behavior. Whereas, you know, on the passive side, they have broad ownership. So their, you know, their only real lever is their proxy vote. And that's a pretty blunt instrument. You know, they can engage systematically, but it's very difficult for them to have much more targeted engagements.
That's a really important point on that, this active process, being able to shape the future of it, having that view towards where things are moving. And I guess, you know, one of the things advisors need to think about that way too, with their, not just their clients' portfolios, but their practice. You know, one of the things that we do see in our research at Natixis is 6 in 10 advisors think that ESG is going to be a standard practice within the industry within 5 years. And it seems to be that even though maybe not as much is being implemented as you would hope or think at this time, based on the volume of demand, that folks are waking up to this and saying, you know, this is an opportunity, this is a chance. And what I'd like to know, if we go around here to ask, what is it they should be looking at when they evaluate an ESG fund? What are the things they should look for? And Jennifer, let's start with you on this.
Yeah, I think that's a very important question, because the market is still debating on, you know, how do you know if it's a good ESG fund or not, right? And also a lot of managers, like all of us, are saying that we integrate ESG factors into the process such that we can generate better return. Well, how can clients evaluate that? So I think the way that we advise clients, and we do for our clients, is that, you know, if it's a ESG integrated strategy, i.e. we're only using ESG in such a way to generate better return, then the metric that's most important to you is financial return. We need to be able to demonstrate to you, by way of incorporating these ESG considerations, are we able to identify risks that we would not have been able to do? And we do the kind of metrics that we provide to clients could be as detailed as company case studies, where we will actually provide to our clients about, here is an example whereby we were engaged with companies and found out about this G issue, which we would have never found out about if we just look at purely what's being reported by the company and others, and, you know, we were able to avoid potentially a loss. For products that go beyond ESG integration, i.e. products that have a sustainable outcome in mind, I would say the most common metric that a lot of people use is these third-party ESG scores. So that's one, you know, framework that, you know, I think Morningstar and many agencies use. I think it's a good starting point, because even though we all talked about how, like, between all of these providers, the methodology is really, really different, but we need to have a starting point somewhere. So I think it's a good starting point. But I think to really help your clients who come into the space with a specific intention. You want to make sure that the metric that you ended up providing is tied to what that intention is. So if there is a social outcome related to gender equality that the client is looking for, that's the kind of metric that you should provide, right? And you can provide that, this is the gender equality related metric of the portfolio and versus the benchmark, right? I think that's the kind of metric it will really help clients to understand that's the value that you can generate as an active manager. So tying to the objective is really critical when it comes to measurement in the ESG space.
Oh, that's great to hear. And then now, Maria, how would you think about this? What should advisors be looking at? The measurement's really important, and defining what you're going to measure, really important to that. What do you think?
I think still in the industry is still not settled on frameworks, on definitions, on reporting. And I think what you also have is you have funds that are specifically ESG labeled, but maybe are kind of talking a little bit about it a little bit more than what's warranted given by their process and their structure. And you have funds that are integrating ESG without specifically labeling the product as ESG product. And I think that makes it difficult for you as you're trying to figure out what makes the best fit for your client. And so what I would recommend is when you're talking to the managers, ask them how they integrate ESG. So I think things like, what they're signatories to, are they a signatory to the PRI or the stewardship code, is a good first step, but don't stop there. So dig further. And then, ask people, what are the key ESG risks in the portfolio? What ESG issues are you paying attention to? What are some of the emerging issues that you're paying attention to? What's market underappreciating? So just dig deeper. And I think that would give you a much better sense for how deeply managers are thinking about it and how deeply they're integrating it in cases where they're integrating it. And to Jennifer's point, ask for examples of engagement. How have you engaged with companies? What topics have you talked about? What have you achieved, etc.?
No, thank you on that. And Mason, just as kind of the final question on here, what is it that you think would be really important to ask? You're sitting across the table with an advisor. What are the questions you'd like them to hear? You'd like to hear from them?
I'd like to hear detailed questions about how we approach sustainable investing. As Maria said, they need to, be able to ask those questions and ask them, over time, because it takes time to learn, from various interactions with different managers, what their responses are. So it's going to be something that advisors are going to have to develop, a deeper understanding of what each response indicates. There's been some concern in the industry that a large proportion of the ESG funds that are available are just traditional funds that have been rebranded, and maybe had some ESG element slapped on them or overlaid. So for advisors, it's going to take practice in having a lot of these conversations with different managers to be able to get a sense, and sort of the ability to kind of see through the rhetoric and understand, what, if a manager really knows what they're talking about, if they're really genuine about this, if they're committed to it, if it's an important part of their investment culture. And I think, if managers or if advisors are really focused on that and diligent about it, they will develop that ability. They'll get there and they'll be able to say, okay, these guys really care about this. They feel like it's critical to their ability to achieve their clients' goals. And, I feel good about the fact that they're walking the walk, as it were. Whereas, other managers, they may not get that sense. But it takes time, and it takes a lot of conversations and practice.
Thank you. And thank you all for your opinions on this today. I'd like to open this up to questions to our audience on this. I see we have a couple coming in, and I'd just remind you, if you wanted to send a question in, send it to panelists, type in the message and send us on. The first one I'm going to start with, this is an interesting question. How do you start the conversation with clients around ESG? We know clients want to have that connection to values. How do you start that conversation? How do you translate it into an investment conversation? Jennifer, I'm sorry. Go ahead, Mason. Go ahead.
No, I was just going to say, I think that you have to have sort of a couple of basic questions that you're going to ask to gauge the level of understanding that the client has, and then I think depending on that assessment, it most likely turns into an educational exercise to educate the clients about what's available, and with your understanding of what their goals are, both financial and non-financial, you can tailor that conversation to a high degree.
I think that's an important part of it. Another question coming in here, is there a way you can quantify the return that ESG has added for you? Say this example over 2020, is there a way to quantify what's been added by doing an ESG approach to your investments? And offer that up, Jennifer or Maria, what are your thoughts?
Yeah, I could take that. I think for us, because, for example, we can do that because of the fact that we've built, our own scoring system, if you like, when it comes to assessing the ESG-ness of a company. And we've been doing this for quite some time. As an example, in our emerging market equity desk, we developed this 90A ESG checklist since 2013. So we've been collecting lots of data. Obviously, over time, these questions evolved. Initially, we had more G of the ESG because it's an emerging market, as you can imagine. But more and more so, we built in the E and S component. So we've been collecting data for a long time based on these, the results of these 98 checklist questions. We made certain investment decisions. What's been the outcome and the result as a result of that? And we could very confidently demonstrate to our clients that this is the value of asking these ESG questions when we engage with companies, and then also focusing on these ESG red flags when a company's actually not doing well. So I think every manager does it slightly differently. For some of our clients, I think the simplest way for them is to just look at third-party rating. That's what they want. But I find what we found is that more and more clients are getting much more educated about the deficiencies with a lot of those third-party rating. So they actually like the ideas of us showing them actual examples using our own, be it using our own scoring system or case studies. But I think to be able to do this consistently will really help you to be able to generate a track record around how ESG is being effective in generating better return for you.
Excellent.
It's harder for us to disintermediate how much of it is because ESG is so embedded in our investment process. But I think one way of looking at it is some of the companies that have performed well as other investors in the marketplace realize the opportunity available to that company, such as with industrial gases companies that we own, for example, and that are participating in the transition to hydrogen potentially over the long term. Another way of looking at it is the companies that we didn't own that blew up. So Wirecard is a company that we used to follow and that the analyst unrated due to governance concerns. And Boohoo, which is a UK online retailer that has gotten into hot water over its supply chain issues. We didn't rate that company because in our initial work on the company, we've identified that social concern that we were not comfortable with.
So we're coming towards the end here. I have one last question to ask here, and it came out of discussion around third-party ratings. And the question that comes in, I think, is interesting. Right? Do you expect there'll be some industry-accepted definitions and standards in the near future? How close are we, or what are you seeing in that? Maybe Mark, if you want to start there. Excuse me, Mason.
Yeah, we're definitely getting closer to sort of industry standard definitions. The challenge is that there are a number of different groups that are trying to do it. And there are going to be a lot of regional ones, I think, before there's, overarching industry-wide global standards. The good news is that I think where the industry is now, it's not like, there are wildly different definitions for the majority of the terms and approaches. And I think it's just a question of, the nuance and eliminating some of that. But, the SEC is looking at it. Obviously, there's a lot of regulation coming out in the EU. in Australia and New Zealand. There's been some movement toward new regulation. So we will see it, I think, over the next couple of years, and it's just going to be, a question of who rises to the top and how much coordination there will be, particularly between government agencies in different regions.
Well, I think that brings us up to the end of the day. Thank you for that answer and really important stuff. I'd like to thank each of you for being part of this, really an engaging conversation around ESG. It's certainly on the minds of most people in the industry and most investors at this point too. We've had some great questions, some great dialogue on this. Folks, if you'd like to see this webinar again or share it with some colleagues, you can be posted to activemanagers.com. Visit the site, also take a look at the ESG report, and of course follow Active Managers on LinkedIn or Twitter and join the conversation of what everyone is talking about in active management. And thank you to the audience for joining us today, and hope everyone has a great afternoon. Thank you.